Consumer sector, that's what everyone's talking about, right? And who better than Marico to speak about what's taking place in the world right now, but more importantly, what they're doing to navigate through the tough conditions right now as well. Who better than Saugata Gupta to speak to us? Saugata, it's always a pleasure speaking with you. You know, the environment is tough. Everyone's talking about green shoots in rural. Everyone's talking about, you know, urban still being 2 quarters away from good recovery, etc. Amidst all of this, you've done better than most of the people when it comes to value and volume growth itself. The obvious question is, what did you do different versus others to benefit from this? And what should companies, traditional FMCG companies, actually do other than just blaming the macro environment to grow faster?
If you look at the total environment, over the last couple of quarters, rural is improving. Urban consumption has been stressed. Having said that, we believe that the worst is over. It will gradually improve. Obviously, the improvement will not be, you know, like a hockey stick kind of a U-turn, but it will improve definitely. Now, I think as far as Marico is concerned, 2-3 things I would say was slightly different. One is, of course, our significant focus on our diversification and transformation of our portfolio to make it future ready. If you look at around 2020, the composition of food plus digital plus premium personal care was around 6%. Today it's 21%. So that is giving us that growth. The second thing is that we have been also not been cutting A&P to manage margins, but doing a far more institutionalized cost management program. Thirdly, some of the issues in the system we called out pretty early. For example, things like GT being under stress, the fact that there is a potential channel conflict, investing ahead of the curve in new channels, and of course the fact that if FMCG companies don't actively participate in the D2C space, they are likely to get squeezed out at the top of the pyramid. So I think some of the things we have taken proactive steps, and therefore that has resulted in that we are still being resilient in this situation.
So 6% volume growth is what you reported this time around. How far are you from the 10% mark? Because, you know, it's a function of what you're doing and it's a function of what the environment is doing as well. Rural you called out as improving. Urban may not be hockey stick. What does the very near future and medium term look like for you?
So I think it's very difficult to say when will 10% happen. I think the question is that we have, if you look at sequential quarter, we moved from 2, 3, 4, 5, 6, that's been the kind of a movement. I think a mid-single digit is something which is eminently possible. Our endeavor will be to gradually move that to, you know, high single digit. I think 10 is something which again is something which will depend on the environment and other factors, but as of now I think our aspiration is how do we inch this up a little bit. I think what we are more confident about is, given there is a bit of a, you know, pricing equation that is there, to deliver double-digit revenue growth quarter after quarter over the next couple of quarters, and that's something which we are pretty confident about. Our endeavor obviously will be to continuously try and deliver top quartile volume growth.
What about the margins? Because your anticipation was 20.5%. You fell short of that by about 150 basis points. That was largely on account of the sharper than expected inflation that we saw. Where do we see that going?
So I think the inflation cycle will continue for the next 2 quarters. Okay, so as far as the copra is concerned, we are broadly at the fag end of this inflation cycle. It's usually 18-month cycle. We expect things to improve sometime towards the end of quarter 1. So obviously there will be a lag and things will start improving from quarter 2. As you know, in edible oil, there's been a 20% duty, which is something which obviously has resulted in some kind of an inflation. I think as far as margins are concerned, there will be a situation where the first 2 quarters will continue to have some impact, but it will start easing off towards the second half of the year.
So how much lower can they go before they go back to that 20% mark?
I think we are in that zone right now. I don't think there will be a significant squeeze beyond this. But having said that, I think our endeavor will be to move it to 20 as we, you know.
But then you'll have the leverage coming in from all your new brands, etc., where they are improving their operational parameters as well, right? So would there be significant growth in margins beyond that 20% mark, or you believe in, you know, passing on the benefit to the consumers and hold your margins around that 20% mark?
So I think value to the consumers is important. because we have taken some significant price increases. Similarly, as far as the digital and the new business is concerned, obviously our endeavor is to continuously improve margins. So to give you an example, if I look at the oats plus masala oats business, which is core of the current food business, that delivers an EBITDA close to the company EBITDA, okay? I think I would say there will be two milestones. One, can we get the digital business, which is a very high growth business, to get into a double-digit EBITDA? Beardo is already delivering that. Plix is positive. There is a bit of a cash burn in terms of the other two, which is True Elements and Just Herbs, but it's minor, it's not major. And so I think as long as, and we are much more comfortable with say a 30% growth with continuous improvement in profits versus delivering a 50%, 60% growth with a high cash burn model, okay? Food is also improving, so I think the margins will creep up, and I think even in our international business there are opportunities for scale-driven margins. But as you see, we are in emerging markets. When we operate right through, in our international business and India and emerging markets, and the focus is to invest to grow. It is about getting new consumers. It is about getting existing consumers to consume more, grab market share, and continuously diversify.
One thing that stands out is that in all the traditional FMCG companies, you've been among the first few to get onto this D2C acquisition bandwagon. So 5-6 years into this acquisition bandwagon, if I had to ask you a couple of questions, what is it that you learned from them, and what is it that you taught to them? And as a result of which the synergies were created. How would you reflect upon that?
I think three things. One is digital marketing. I think something which we have really learned and tried to improve our capability in that. The second thing is high velocity innovation, risk taking, and ability to gather insights from the environment and quickly launch. So it is about think big, start small.
Could you give me specific examples?
I think if I look at the innovation cycle compared to a traditional FMCG company versus say some of these D2C companies, it's severely crunched. They are happy to take small bets and risks because the risk appetite, I would say the risk appetite is high, but I think the value at risk is always low. I think what they have learned from us, I think, is cost management, governance. I think also a little bit of framework for choice making, because unfortunately in some of these companies, I'm not talking of our companies, but we have seen some of the startups, it's about spray and pray.
Yeah.
I think that ability to do sharper choice making without analysis paralysis,
right, and
something which they have learned from us.
And what about the threats? What do you think would be the potential
I think the 2-3 threats obviously is that core slowing down. I think whenever there is significant pricing interventions, and if I look at volatility of raw material, commodity, and therefore we are actively ensuring that we de-risk ourselves from commodity dependence.
How much has it de-risked? Ever since you joined, I remember over 60% of your revenues would come from...
I think there's been a significant de-risking, and we still want to continue the journey. And I keep on saying that my aspiration or ambition is that we do an analyst call 3-4 years from now where copra is not discussed.
Okay, that's an interesting one. So how much do you think have you decommodified your business? Not just copra, but even edible oils?
Yeah, so as far as edible oil is concerned, I think what we have said is that the growth of the Saffola master brand has to be through foods.
Yes.
And again, in foods, we are cherry picking categories which have higher margins. I mean, there's always a temptation to get into things like rice, pulses, and spices and all, which will give me quick growth. Yes. But we have resisted the temptation to do that, because I think one of the things we said that the food business should be far more margin accretive, and maybe 3 years from now, food will be bigger than edible oil in the Saffola.
50-50 was your target, I remember. Where does that number stand right now?
It's still around 30-70, 35-65, it was around that. But it should be 50-50 very soon. And maybe 3 years from now, we should be a higher food business,
That's incredible, because I remember the first conversation that we had almost 8-9 years ago. You said that you're going to be a total foods company. And 8 years since, you've met all those targets. You've said 500 crore in food, that's happening. You've said 1,000 crores in food, that's happening. Now you want to double that to almost 2,000 crores as well. So what we'll do is, since we are talking so much about food, and it's very close to breakfast time as well, let's go down and see what are the new products that you've launched. Because I'll be very honest, personally, I'm not a very big fan of the way some of your masala oats taste. I wonder if you can change my opinion out there.
Absolutely.
All right, let's go. Why are we taking steps once again? We're on the 9th floor.
Saffola, advises you to have a rose ka healthy step, and we have offices on the 7th, 8th and 9th floor. So whenever I have meetings, I always take the steps.
What do you believe your growth strategy is? Taking the staircase to growth or taking the elevator to growth?
I think taking the staircase to growth, and of course pause whenever you need to.
Not only is your diversification revenue split wise, it's category wise, and you're trying to de-risk from various geographies as well. What's the entire broad thought here?
I think we want to reduce the concentration risk first on the core. I think we had a significant dependence on Parachute coconut oil and Saffola oils. So there was first reduction in oils. In our international business, we had two steps of diversification. First, we had a significant concentration risk of Bangladesh, and it was independent of what happened last year. We had started this process some 3-4 years back, and within that also reducing dependence on coconut oil. We don't have too much Saffola outside, and therefore if you look at it, all our acquisitions, whether getting into Vietnam, Egypt, has been in the areas of male grooming, and now we are also diversifying for male grooming in Vietnam. We have brands like Lashi, Purity and all, which are into female, this one on Shah Gel shampoo. Similarly, in the international business now, today, the non-Bangladesh business is now around 60% and 60% plus, and we are gradually and accelerating that.
So your total addressable market when we last spoke was what? And when we next speak, say a year from now, these long format conversations that we have, should it be what?
So I think it's a sum of the parts, but I think what we have done in the last 4 years is actually done a TAM expansion of more than 100%.
Okay.
And the biggest one being in foods, for example.
Increasing in TAM, you also fear the increase in competition, right? And with increase in competition, there is also the fear of increase in cost compression of margins. How do you navigate through that, and what would Marico's right to win in some of these categories be?
I think we have been only selecting adjacencies where we have a right to win through differentiation. If you look at our shampoo journey, for example, in the Middle East and Bangladesh, it's about extending the coconut equity, the goodness of the brand, nature. So therefore, in every country, for example, if you look at it, there is a space for a natural player to enter into that category. I think we are not participating in categories where you don't have a right to win.
Okay.
And for example, developing food capability across markets is difficult. So we are focusing all our food in India. So we are entering categories where we believe that with our differentiation and our proposition, we have a chance to grab a certain market share. We will not get into commodities as a result, and also we will not get into categories where we believe we don't have a differentiated proposition. Yes, there has been failures, but I think the issue is very simple. If you get your product proposition and your value equation to the consumer right, sometimes it's the execution you can't get it, and you have to get that execution mix right, and it's a continuous process.
If you could quantify some of those parameters basis which you decide a category. So say the market size has to be this much, it has to grow at a certain pace, gross margins have to be this much, and your targeted market share has to be this much. How do you quantify those parameters?
So I would not get into specifics, but obviously we look at market attractiveness and a right to win.
Okay.
And market attractiveness could be obviously growth rates, is there a space, this one, we look at the regulatory part of it, we look at, in terms of penetration of the category, in terms of right to win, we look at, have you addressed these consumers? For example, just let me take an example, like pet care is a very attractive category, but I don't have a right to win because I have not addressed that segment at all. So I think we look at common consumers, common channel, common logistics and distribution, and common cost structure and capabilities. So we have a very methodical framework, and of course one of the things I push towards is that do few things, but few things big.
What is the minimum growth that you seek when you enter a new category, and the minimum gross margins?
Obviously there are different margin aspiration for food and personal care. In food, obviously the margins are low, but we need to get scale, and that's why it's important that just like we have got scale in oats and masala oats, we get scale in some 2-3 big things, like for example looking at breakfast, we're looking at snacking in a big way. I think in personal care, again, the issue is if you look at, if I participate in a category, there could be certain subcategories which are growing at the top of the pyramid, like in digital and modern trade. We need to participate. Now, whether we're participating through our digital brands or some of our old brands, let's look at serum as a case.
Yeah.
I can participate through, I think today what has happened is that today I have a host of brands to participate in a single category across different price points and laddering each one of them.
All right, got that. We are here near the canteen. So let's go. Let's get some masala oats, is what you said?